Hello viewers and welcome back to the Dukascopy TV studio. I'm Ben Jones and alongside me is Emmanuel Ferry from Banque PBS. Emmanuel, thank you very much for coming in again.
Hello.
Now we're going to be talking about asset management, so I'd like to begin by looking at the year just gone. For you, were there any standout areas with regards to asset allocation, and did anything surprise you throughout the year?
Yeah, actually 2013 was a year in which many market concerns, many macro risks never materialized. I mean US fiscal cliff, the end of the euro, or China hard landing. So the key fact, volatility has been crushed by massive central bank additional liquidity, almost 150 billion a month, and this sharp fall in cost of risk has been a fantastic driver for risky assets and mostly for US equities. It seems today that US equities are the new safe haven asset, replacing precious metals or government bonds. From an asset allocation point of view, diversification did not really work last year because while developed market equities performed quite well, three major asset classes showed losses, big losses: commodities, emerging markets, and government bonds.
Okay, and now looking ahead to 2014, do you think any particular asset class will be a key driver throughout the year? And are there any areas that you would advise our viewers to be careful around?
Well, equities, the case for equities will remain very compelling because momentum is good. Flows will continue to support the equity asset class with a rotation from fixed income to equities. From a macro point of view, the combination of below trend growth, no inflationary pressures, it's a sweet spot actually for equities. And from a micro point of view, the corporate sector is still in a very good shape with a lot of cash on the balance sheet. Plus a lot of activity on the merger and acquisition side. Cash will return to the shareholder, etc. So, and from a valuation point of view, on absolute and relative terms, valuation is not demanding compared to government bonds or compared to credit. So I think the opportunity for a market melt-up is quite high regarding global equities. And last point, almost 80% of portfolio managers underperformed their benchmark last year. So it means they will continue to chase the rally and to buy on dips.
Okay, so moving on, there's a lot of talk about developed economies once again increasing their interest rates. Could you comment on how this will affect specific asset classes? Well,
it is true that we are probably at the end of the global monetary easing cycle. So, but the repricing of interest rates will remain very gradual because central banks will stay behind the curve and the environment is still very benign from a fixed income point of view. So the repricing in rates is definitely a headwind for the fixed income space. But regarding equities, given the fact that there is a high risk premium on equities compared to bonds, it will be a buffer and equities can continue to rally despite rising interest rates.
Okay, and finally, the Fed tapering. Could you discuss how you think this will affect asset allocation throughout the year?
Tapering will continue despite the fact that the Fed will remain very cautious. The monetary policy in the US will remain very accommodative. So globally speaking, it's still a supportive factor, but it's true that lower liquidity means lower returns and higher volatility. Probably greater volatility is a new element this year compared to last year. And it should be supportive for the dollar and it should be bearish for gold for another year.
Okay, Emmanuel, thank you very much for joining us again.
Pleasure.
And thank you viewers for watching. Make sure you stay tuned to Dukascopy TV for more updates and exclusive interviews. But for now, goodbye.